The housing shortage is over, way over. Inflation is down. Will interest rates follow? I guess that depends on who you ask. And housing starts are up. And what nobody saw coming. Well, maybe JG, we did.
And it means, Ottawa, we have a problem, and a risky one. And it isn't Trump or tariffs. And the canary is in the gold mine. Is shit hitting the fan? You're going to find out on this episode.
Let's rein it in. Just a reminder to subscribe, to hit that button and like, and please give us your comments. We love to talk about your comments, and we're going to bring them to the show.
All right, Patrick, I want to start the show by talking about inflation and interest rates because inflation is down, and the big question on people's minds is, are interest rates going to follow? And the next announcement is September 17th, but that's not the full story, as you know, because that's just the announcement for the Bank of Canada. You know, I guess we got to talk about bond yields as well. We'll talk about all of it, but where do you see interest rates coming? I feel like real estate investors, like they need some relief and some reprieve. And we've seen interest rates come down in certain categories, but definitely not in all categories. So give me your thoughts on this and let's get into it.
Well, it's interesting. I've been renewing mortgages, recently. I've actually did 3, and then I had a couple more and a couple more. They're just kind of trickling in. Best rate I'm getting right now, really, and I think it's a 3-year. Now, because I got new numbers this morning, I'm a little confused, but I think it was 4.25, 4.35 is about the best I've been able to get. And on a couple of them, I actually took variable. Now, that was because mortgages.
But 4.25 is not too bad, Patrick. I mean, is that because you're really old and really rich? Is that that's a pretty good rate?
No, I'm not complaining too much about the rate. I mean, I would always like it to be a little bit less. But, again, my portfolio overall is pretty mature. So there's not big mortgages anyways. And a couple of them were small enough that I went, something I'm going to do variable, pay a little bit of a premium. I did open or sort of closed variable, and I'll see what happens in September and then by the end of the year. So this goes back to the interest rates, and even we can talk about inflation. So when we look at what's happening and kind of what's unfolding, I think Bank of Canada, I think we might see a quarter point in September. And the reason I'm saying that is because we'll talk about inflation first. So CPI is down, and that, is what most of the general public hang their hat on. Of course, the Bank of Canada looks at core. And so core is made up of different numbers, and it strips out a bunch of things that they want to look at, like the volatility of food and fuel, for example, or housing costs. So the point is that the core inflation actually isn't down. And so we look at what's happening, and I think the Bank of Canada is really between a rock and a hard place again, or still. And the reality of it is inflation isn't coming down, but here is what is happening, and it's going to get far worse. JG, we've talked about it many times, and we're going to start to see unemployment continue to creep up because as the housing sector, so let's connect some dots. And I know I'm going to go off on a little bit of a tangent, but here's the thing about it. You've got a slowing housing economy or a slowing housing market. And although it's kind of seems to have flatlined right now and there's some upticks here and there, bottom line is housing is slow. And we're going to talk about that in a little bit because on the surface, everybody thinks we're rocking it in housing. We're not, but we'll talk about that.
Who the hell thinks that? Who thinks we're rocking it in housing?
Well, no, we'll get to that segment in a minute. We'll talk about that. That's a teaser for people to pay attention to this because because housing starts are way up. That's the headline. But guess what? We'll unpack that in a minute. So my point is this. We look at what the Bank of Canada's got to deal with. Core inflation is, in fact, not coming down. It's stuck right around 3%, the higher limit, or just a low or high 2s. So it's the upper limit of what they say they want. But then you've got unemployment creeping up. And so when we look at interest rates, unemployment's creeping up because everything is slowing down. We're seeing retail slow down a little bit. Businesses aren't hiring. They're not borrowing money. They're not buying inventory. And some of that is caused by tariffs. But, tariffs and Trump is just one giant federal government excuse. I'm so tired of it. I can't even listen to Carney anymore. They're so full of shit.
I can see the progression. A month ago, you were giving Carney a chance. 2 weeks ago, you were losing patience. And now you're tired. You can't even listen to him anymore. I've seen the progression happen.
Well, because he's full of shit. I gave him, I said, okay, let's give this guy a chance to see if he hasn't fulfilled on one single promise. Carney's a loser. So is frickin' Sean Fraser. Like, what the hell is with these people? Anyways, let's go back to interest rates. So I think there might be a quarter point in September, maybe, but I think by the end of the year you'll see a half point drop. I think that Bank of Canada is going to have no choice, because arguably GDP has flatlined. It dropped, I think, 1.8%, which puts us on the low side. Technical recession, maybe not, but let's face it, Ontario is in recession. Full stop. And all you have to do is look at unemployment, look at how many people are quit looking for jobs. So there's a lot of kind of things to unpack when it comes to that unemployment number, because on the surface you go, wow, okay, what's happening? But there are people, they're saying 7%, let's say. Toronto proper is like 10%. And they're going, well, it's creeping up. It's kind of flatlined. But no, what's happening is it keeps going up. But a lot of people have quit looking for jobs. They've just quit looking for jobs. So they're not included anymore.
So let me jump in here, because I'm not sure if you've taken your Xanax today, but you're very hyper, Patrick. So I'm going to ask a couple of questions here.
Okay, please.
So you say that Bank of Canada might lower interest rates in September. Definitely will lower interest rates before the end of the year. Is that's a Patrick prediction? I want to put that on the record.
Yeah, put it on record. I think they're going to have no choice, and the bad news around all of it, we're not going to like
it. The confusing part to me, Patrick, is the slide that we're showing about core inflation, and you're right, core inflation is at the upper limit, and the number one objective of the Bank of Canada is price stability. They will fight for price stability, which is inflation. You can call it shit all day long, or crap, or mismeasured, or whatever. But in their minds, they fight for price stability, which is they want to keep core inflation below their benchmark, even at the expense of unemployment and GDP production. They've even said that publicly on record. So my question to you is they are between a rock and a hard place. We've seen this before. It's not the first time. We're seeing it again. Core inflation's at the upper limit. We're starting to see unemployment become an issue. We're starting to see GDP become an issue, but core inflation is now creeping back up. So why are they going to cut? Because if they might not cut. I want them to cut, but I don't know. They might not cut.
I think they're going to have to, because economically we're struggling. So costs aside, so this goes back to things we pointed out even as much as 18 months ago, more than that. This was all ramping up to, and could very well look like stagflation. So in other words, prices continue to rise, unemployment continues to rise. The thing about upping rates is let's look at shelter costs and let's look at food. It doesn't matter, or housing costs. So when you look at the cost of a mortgage. So the point of it is that core inflation isn't really, they don't have control over food prices. They can up interest rates all they want. People still need to eat, and the cost of getting food into this country and to import and transport and all the rest of it, interest rates aren't going to affect that. So it doesn't slow things down. And remember is that interest rates don't control prices, they control spending. And so people still have to eat, they still have to drive. So the point of that is that interest rates aren't going to have an impact, a large impact on some of the core inflation that they're trying to control, and within the CPI basket overall it does. But what will happen is we're going to see rents come down, we're going to see some cost of housing come down. And I think at that point, they'll be compelled to lower rates a bit. They have to. I just, either that or we're this.
Listen, I hope so.
Worse.
I hope so, but I'll tell you this, like from where you and I have had these conversations before, and I don't want to get too esoteric, but with all the AI stuff hitting the market and what we know that's going to do to unemployment, I mean, jobs are not being replaced right now. That's one of the biggest pressures on employment is jobs are not being replaced. And people are waiting. Patrick, you're in the same boat as I am. I own several businesses. You own several businesses. And we are literally just like, I've probably hired 7 or 8 people in the last 3 weeks. But I probably could have hired and should have hired like 15. And I'm just trying not to overhire because I know that tech is going to help me do some of these jobs without hiring people. So, and I'm not the only business owner in this situation. Everyone's in this situation. My point is that the Bank of Canada is going to be fighting this unemployment trend for a very long time to come. I actually don't see it ever getting better.
Well, so let's park the AI conversation for just a moment. Let me finish one other before I step over it, and that is that the unemployment that we run into in Canada, we've said this a million frickin' times. Our economy has been being driven by real estate and consumerism. Consumerism driven by immigration, and that's what our economy has been made up. The most of our GDP, by the way, has been driven by real estate and consumerism. We don't export, we manufacture very little, relatively speaking. So to your point, so first off, housing is slowing down and consumerism is slowing down, and that's what was driving our economy. And immigration is slowing down, so we don't have as many people buying things. So that's the first part that we can't step over. We have to pay attention to what Canada is doing economically on the export side of things. So that's the first part of this. Let's talk about AI. And I think we have to be cautious, JG, because I do hear what you're saying, but I'm old enough to literally remember when computers started coming online. And I was in the workforce and I was like 18, 20 years old. And I was like, oh my gosh, computers are going to take everybody's job. And of course, what came out of that was a whole new industry and a whole new shift of what people are
100%.
doing. So I think we have to be a little bit careful is that.
Well, yeah.
Yeah. I wanted to just let me finish a couple things because I've done some research on all of this and I've really been paying attention. So I want to share with you one insight that I've heard a number of CEOs who are very progressive in their thinking have said. I use AI. We are intending to lay no one off. We are encouraging our team to use AI, to learn AI. We're supporting them in doing that because it is now a tool that's increasing their productivity and it's increasing their efficiencies, and therefore they're getting more done more efficiently, more effectively, and better. So that's one other way to look at it. But to your point, I think technology, AI aside, technology is going to continue to eat up a lot of jobs that we're used to people working. I mean, just look at the robotics, and guaranteed over the next 5 years, you're going to see huge shift in robotics. We already are.
I think, yeah, that's a great point. And that's that. And I want to be very clear on my position on this is I don't think AI chews up, jobs. I think what AI is going to do is to make the pie bigger for everyone. And that though there are some jobs that will have to be retrained, people will have to retrain out of what they're used to doing into something else that is more valuable, because the low level stuff, it'll definitely get replaced. Even the high level stuff, it'll get replaced. And people will have the opportunity to do exactly more of what they love to do. And I think that'll, in the end, will turn out really well. That's my overall position on AI. But in the reality right now, Patrick, and I know you're in this position, I'm in this position, and I'm having conversations with my chief operations officer and the rest of my management team. I'm saying, listen, guys, we need a second and third receptionist right now. But I am not hiring one. Why? Because this job is going to get done by AI for sure. And I'm looking at AI solutions in order to put that in place before I hire the next person. That's what I'm saying. And I'm saying this is essentially, this is creating pressure on unemployment. I'm not saying that it's going to ultimately, I just think that's my point, is it's creating pressure on unemployment. And along with the rest of the pressure, the GDP pressure, all the stuff you're talking about in terms of like the fact we're not exporting, all of that is 100% true. But this AI pressure and this new technology wave is going to just add that next element of pressure that the Bank of Canada is going to have to deal with. And this is not going to go away. Like, this is not, that part of it's not going away. They're going to have to deal with this for the next 3, 5, 10 years until they get it figured out.
So let's talk about unemployment. Yes, to your point, JG, the AI thing is going to cause a lot of concern, and there's going to be kind of a ripple that people have to deal with. There already are. And so we'll see where that all kind of fleshes out over the next few years. But ultimately, it is going to be a disruption to some categories of jobs, or a lot of categories. But what we don't know is and nobody knows this, by the way, is what is the new jobs that are going to come out of this wave of technology, because it's going to create new positions, new jobs, and it may not even be in technology, by the way. But the point of it is that we don't even know where we're going. And I only go back because I'm looking back in 85, 86, 87, I was talking to members of the team with the corporation, the only job I ever had back in those days in the oil field. and sales guys and administration team, they're all, gosh, we're going to lose our jobs. This computer's going to take it all. And those are the old stories back then, right? So now we laugh.
Well, not, and you know what, Patrick, let's talk about that though, just because I know there's a lot of fear around this. And you know what, some of those guys did lose their jobs, but ultimately, as an aggregate, the pie is way bigger today than it was in 1985, 1986, 1987, and so on and so forth. And it's the same thing that's going to happen today. Will people be displaced? 1,000%, and some very significantly. But if they have the will and if they have the resourcefulness to get retrained and to upgrade their skills and to modify their skills, there's going to be incredible opportunities. But that willingness is on them. Just like those people, like there's one guy from 1985, Patrick, that cantankerous son of a bitch who thought he was going to lose his job. He did lose his job. He said it would never be the same. And now he's passed away. And in his world, life was never the same. But that's just one guy. You know what I'm saying?
Yeah. The two corrections I have to put in. I actually have to go back another 10 years. It was actually 74, 75, 76, 77. That was kind of, gosh. But primarily the guys, I know that's how old I was, or I am. So the guys who did, and I want to say this, is the guys who did lose jobs, guess what? They were older, cantankerous individuals who said, I'm not learning anything about computers.
That's right.
And if you are sitting there going, they want to take my job, take it. Okay, so let's move on to a different layer conversation.
Okay, before we do, Patrick, sorry, I got to touch on one thing, which is I want to come back to interest rates for a second, because I don't think as a real estate investor, and there's a lot of real estate investors that watch this show, so I want to speak to them specifically from my perspective as a very active real estate investors, because Patrick, you and I are in different, let's call it areas of our life. I'm a very active investor. You're a much more passive investor at this point in your life. But as an active investor, interest rates are not my biggest problem. I don't care. Interest rates could stay right where they are. They can go lower. Fantastic. They could even go maybe a little higher. Wouldn't change anything for me. But the availability of capital is a big friggin' problem right now. There is no money out there. There's a lot of private money because as traditional lending channels tighten up, private money opens up, right? They have an inverse relationship, just so everybody knows. So there's a lot of private capital out there, but A, it's expensive, and B, and it's got its place. I use private capital almost every single day. But man, we need the traditional lenders to play their role and to make liquidity available in this market. And to me, I'm no economist, but the only thing that's going to make that happen is some freaking stability in the marketplace, because this instability and this all of this craziness has them freaked out, and that's really hurting, Patrick. To me, that is one of the biggest causes of this. Of the fact that deals are not moving, real estate's not moving, is a big part of the availability of capital. It's just not there right now.
Well, liquidity is drying up, and the reason it's drying up, JG, is really clear. The banks are waking up. OSFI is woken up to the fact that their book of business is quickly getting upside down. So as much as we think about banks making money and all the rest of it, they're not lending because they're upside down in a lot of their portfolio. So imagine houses that they lent, based on a 1.5 million valuation, 20% down, all good in the hood, 80% loan to value. We got this. Well, guess what? That same property, if you look at from the peaks when they were lending, how much capital flooded into the real estate market at the peak. And now those peaks are down 15%, 20%, 25%. I've seen numbers in some regions as high as 28%. So if you're the bank and you're sitting on those loans, you're upside down. And so they are very nervous, I think, about their lending, and they're going to make it harder for you to, because they're at risk, and they're going to try and cut back on that risk side of the issue. And now, as you start to, so also keep in mind, JG, is that the banks are not oblivious to the fact that the job market is softening. And if you've got borrowers who are now not employed, you got a bigger problem. So they have to tighten it up. And that's, I think, going to be, and I think we're going to see that over the coming months. that they're going to continue to stay tight in that aspect of lending. And I think that's just what's going to happen. I want to go back to unemployment. I know we're jumping all over the place, but I don't want to step over one fundamental thing, is that when we're looking at the job market, and we had a chart for it, I think we still have it, but that is, where are the freaking jobs? Well, guess what? The jobs, again, are public sector. So we see this, we had 33,000 jobs or something, whatever the number was. It was really minimal, relatively speaking, and I don't trust it anyways. But we do look at the number, and guess where the jobs are? Public sector. We keep hiring administration. This is not how you make a country productive. We've said. Remember when we said, and somebody pushed back.
I'm still going for Patrick for Prime Minister. I'm still there, Patrick.
I'm in. So do you remember a while back, I think I made the statement, is that if we ran the country like a business, we wouldn't be making these decisions. We wouldn't be running this level of deficit or this level of debt. But we've got politicians, and business owners don't want to be politicians. Otherwise, they'd run this country. You're starting to see what Trump is doing. And you can hate Trump, and we can all have whatever the stigma is attached to Trump, but he's making some good moves. I don't agree with all the stuff, by the way, and I'm not a huge Trump fan. But the point is that when I said treat the country like a business, run it like a business, and everybody would be far better off. Did we ever get pushback? I can't believe the number of comments that people go, yeah, but you got to have compassion for people. And I'm going, what has that got to do with running it like a business? There's lots of businesses out there that have huge compassion for the people that work with them. Look at the business that you run. You've got a great team. You run a great team. You are happy to be a profitable business, and people are happy to get paid and have jobs. So it blows me away. Anyways, I'm being very frustrated today with what's going on in the world.
Well, Patrick, I put up the slide on employment because, you're absolutely right that, I found it fascinating. When I saw the slide, I was like, wow, other than public admin and recreation. And I find it interesting that arts, entertainment, and recreation is up, given the fact that GDP is flat and so many people are struggling. That's all seen people to talk about, is how expensive things are and how expensive groceries are and how expensive just life is in general. I hear it literally every single day from just everyone. I find it fascinating that arts, entertainment, recreation is like the only private sector category which is up in employment. That and public administration, every other sector, Patrick, every single one is negative employment right now. And by the way, in case people are listening, Patrick and I and many other economists and business owners, we prefer to look at employment versus unemployment, because Patrick said something very interesting about 27 rant minutes ago, is when he said, if people stop looking for employment, let's just say they're unemployed and they stop looking for employment, the government doesn't count them as unemployed anymore because they're not looking for a job anymore. They're not. So all of a sudden they fall off the statistics. So those stats are nothing but bogus. And so the employment numbers are much better than the unemployment numbers for figuring out the kind of healthiness of a region from a jobs perspective.
The number of people looking for a job for 6 months or more, 27 weeks or more, is off the charts. So it's just getting soft. That's all to say that we have to pay attention to that as real estate investors. And okay, so let's move on from this talk of, we know that inflation, I think interest rates by the end of the year are going to come down. I think it could come down as much as 50 basis points. I would anticipate that. I think the Bank of Canada is actually going to have no choice. And yeah, so that's where I'm kind of recap on that. I don't think inflation is going to come down as much about core inflation, but we'll see what the Bank of Canada does, I guess.
Now, Patrick, so I love it. Great conversation. Let's move on to housing starts. Let's move on because the fact that housing starts are way up, and like you said, the media and just people in general are touting this as like the real estate market's on fire, which is very far from the truth. This correlates with the housing shortage. Your opening headline of the housing shortage is over, way over. So let's connect those dots for people.
Okay, so the thing with media headlines, and this isn't in the mainstream media yet, but you'll start to hear about it in the coming weeks, probably months, given how mainstream media operates. But the point of it, what we've got going on. When you look at housing starts, then you say, well, let's unpack that. Let's look behind that headline. Look behind the data, and what you very quickly see is that housing starts is not categorized. In other words, what are the sectors? What are the property types? And you start to then quickly discover that the multi-family purpose-built rentals are off the charts. So in other words, we look at, and this we're going to talk about banking and CMHC. We did talk about it a little bit earlier pre-show, but the point of it is, JG, is that most of the housing is almost all of it in terms of growth is in the purpose-built multifamily sector.
Well, here's I'm showing a chart now, Patrick, on screen that is showing how rentals are up. Single family is down, condos are down. Rental is the only thing that's up, frankly.
Yes, and I think there's a couple of charts in that package that we've got that it's like hockey stick, boof, boof. It's really crazy. But here's the thing: that's just on the purpose built. That's in the pipeline. Add to that all of the condos that are sitting empty with the Toronto, Vancouver condo market meltdown. Now, all of a sudden, this housing shortage that we thought we had on the rental side of it and the increasing rents, and the government needs to do something, and we need to beat up those dirty landlords and all the frickin' stories that came out of that. Well, guess what? We're seeing multifamily come online in a big way. So there's a couple things around it. Multifamily's up, immigration's way down. So now we are going to have, and this is stuff that's still coming online, JG. So this is in the pipeline. This isn't going to come out to fruition for at least a number of months, even over a year. So now we've turned down the immigration taps. We've kind of turned them off almost, arguably, but that's a different conversation. The point is that we're going to see a very soft, in some markets, very soft rental space. And now with rent controls, it's going to get messy, especially in Ontario and British Columbia. That's just the reality of it. You've got unemployment going down. You've got huge supply coming online. It's really the opposite problem that we had in 2022 when things were peaking. Well, now everybody's going to be freaking. So you've ever heard the term peak and freak? Well, that's what we're going to go through. So that's okay. So that's my rant on that. You want to say something about that?
I definitely want to say something about that, which is, I'm seeing it firsthand in the market, Patrick. We've been talking about this for months now, how rents have definitely softened up, and as a result, and if I had to quantify it, well, I could tell you, I could quantify it. They're down in my various markets somewhere between 0 and 10%, and the scale there is. The better the apartment, the better the location, the higher end it is, and the shape it's in dictates how much it's down. If you have something brand new that is in great location, that has a great layout, that it's been invested in, then you might be down 0%, 1%, 2%. You're down very little. If you have an apartment that hasn't been maintained in 5 years, it needs a coat of paint, it needs floors, it needs a kitchen, and it definitely cannot compete with the other stuff. You're down probably 7, 8, 9, 10%. So if you were used to getting $2,000 a month, you're probably only getting $1,800 a month now. Not to mention, you're not. If this would have happened, if I was telling you this 6 months ago, I would have said the average takes roughly about 2 to 3 weeks to fill something. But now those kind of, let's just call them C-grade apartments, those C-grade, I'm not talking slumlord stuff. I'm just talking C-grade. A grade is perfect. It's brand new. It's excellent. B grade is like it's been renovated maybe a year or 2.5 years ago, but it's still in really good shape. And C grade, it's like 5 years old, needs paint job, needs all that stuff. Those, not only are they renting 10% less than they were 6 months ago, 8 months ago, but they are in fact staying vacant for not 2 weeks, not 3 weeks, but a month and a half, 2 months sometimes. So that's the real world effects of what you're talking about, Patrick. And this is why I've been telling owners, especially people who work with Vistra Property Group and Vistra Property Management, is don't hesitate to renovate your units. Your antidote to this whole slowdown is renovating your apartment. Put a few bucks into it. Do a paint job, do floors, do kitchen counters, invest in your property, and you will not only weather that slowdown so much better, but when the market picks back up, and it will, this too shall pass. When the market picks back up, you're going to be the first one where you're going to get a better appraisal than everybody else. So that's your antidote, Patrick, from my perspective.
Yeah, I think a lot of what you said does hold true, but there's a couple things that we can't step over, and there's certainly the cost of money. So in other words, it's one thing to say just update your unit. Great, if you have the liquidity to do that, okay. But if you don't, then you tap into a line of credit. Well, that line of credit's cost.
Whoa. Okay, fair enough, Patrick. There, I understand, but since you're bringing this up, okay, if you don't have the liquidity to hire a professional to go paint your apartment, then get off your ass and go paint it yourself. Paint is a whopping $300.
Okay,
don't tell me about liquidity. You don't need liquidity. You're rolling paint, bro.
AG, let's settle down a little bit. You're talking about in this idealism world that you live in as Mr. Frickin' Developer with your team and all the shit that you do. Got it. But if I'm living in Ontario and I own real estate in Calgary, or vice versa, or I'm in Calgary and I have real estate in Vancouver or BC that's got to be upgraded, and I don't have the cash, I'm not flying to BC to paint my own unit. That's nonsensical. So as much as what you're saying is true, we can't paint it all with the same brush.
Yes, I got you, but you're outlining an edge case there, and there's a lot of people that own. Listen, if you own properties out of province like that, the odds are is you have some liquidity and you can afford a paint job. You're probably the bigger issue, Patrick, and I agree there's some edge cases there. Fine, I'll give that to you. But the much bigger problem is people's unwillingness to invest in their apartment and them not running this like a business. You and I have been teaching this for years. I know you agree with me. They don't run it like a business. They run these properties down, and those are the properties that are paying the price. So you know what? I mean, that's the reality that I've seen for.
Yeah, well, we've said it many times, right? Boom cycles hide a lot of mistakes through the boom. The mistakes don't show up until we have the inevitable slump cycle, which we're going through right now. And that's just the way that is. So all to say this is that when we look at what's unfolding, and I'm looking at the data that we're seeing today, and you play this out a year, and this is the challenge with looking at data and using it to see the future and kind of connecting dots, is we're not going to be right for 12 months. We're not going to be right for 18 months. And in the meantime, people are making decisions that they're making based on what's happening today. And although that's information, you can't quantify and make decisions based just on what's going on today. That's the first lesson in all of this. We do need to get to the point and start to talk about what do we do given the real estate market? How do we put our capital work? That's still a fundamental question that many have to ask themselves, given the rising cost of living, the fact that wages are not keeping up with the cost of living, not that they ever have, but it's the spread's getting even bigger. And, what do you do with capital to stay ahead of what's happening and what's unfolding? So before we go there, though, let's talk about this multifamily this buildup of purpose-built rentals and what that represents. And this goes back to what I said earlier, MLI Select, we've talked about it many times, a lot of liquidity going into that sector, developers who can't sell condos, who can't get their condo projects off the ground because there's no pre-sales. What are they doing? They're pivoting into the purpose-built multifamily space. Well, they're going for CMHC financing, and where the risk in all of that is when these things come to fruition, if their whole project is based on market rents and they haven't allowed for a fluctuation, let's say 10% down to your point, these are going to come online. They're going to go to rent them out. And if you were budgeting $100,000 a month for rent based on your buildings, plural, building or buildings, and all of a sudden that turns out to be, I don't know, let's say it's only $90,000 a month or $85,000 a month because rents aren't there to accommodate. that puts CMHC at risk, which puts our government at risk. And I think there is a risk for an epic kind of meltdown in that space.
I don't, Patrick, it's an interesting point. I don't know. I'm debating in my mind whether this is Patrick's doomer, gloomer, boomer, or because I'll tell you what, listen, you and I have been dealing with lenders now, you for 40 years, me for 20 years. And I'll tell you one thing is they are ultra conservative. They barely count all the rent. Like their numbers are so damn conservative and their LTVs are so low and everything is so conservative that, most of the market, that drop has already happened. I don't see another 35-40% drop coming out of the market, Patrick, in order to create this doomer scenario you paint. And I know you're just I get it. I'm just poking fun at you. But the point that, I just don't think, Patrick, they are so tight with their forecasts, and they, I have rentals that bring in $7,000 a month, but on paper the bank only registers it for $4,500. It's like, holy shit, and it's the same with the bigger buildings. This is how they work. It's ridiculous.
But let's keep in mind something to that point, JG, and then we can kind of move on, is that the MLI Select, they've shifted it this year. And so it really was kind of focused now, more focused to the experienced developers, those individuals that that's what they do for business like yourself. But think about the do-it-yourselfers that a year ago were going into builds. They're actually, within the programs that they were involved in, they're actually anticipating being able to pull their cash off the table. And I think many of them did not budget for the possibility that doesn't happen. So I think that's also where we are at risk.
I will 100% agree with you there. In fact, I was talking to an MLI, an energy auditor who just did the energy audit on one of my MLI deals that I'm working on. And interestingly enough, he said to me, we're running through the numbers and we're talking about energy audits. And because based on the energy audits, that's how many points you get for the MLI Select program. So we're running through the numbers, and he asked me a question. He asked me a question about finances. And I said, oh no, like I plan on leaving somewhere between 20 and 25% of equity in this deal. And he says, this was his reaction to me. He says, oh, good. And I'm like, what do you mean? Oh, good. I don't understand. Like, why is this? Why are you bringing this up? Why is this a concern for you? He says, I can't tell you the number of people that get into these MLI Select programs and they expect to leave no cash in the deal and they don't have the money to leave in the deal. And they're trying to make this work and not leave any equity in the deal. Well, Patrick, if you're putting yourself in that position, that's a really tough place to be. And with just like any real estate, you should be expecting to leave 15, 20, 25, maybe even 30% in the deal in order to get a good ROI. This is about ROI, not putting no cash in the deal. You know what I'm saying?
Yeah. Well, here, let's go back to this fundamental. Okay, let's talk about this because, to your point, I'm not talking doom and gloom. I'm just giving the data, and I still believe so strongly in real estate, as you know. The point of this is that boom cycles cover a lot of mistakes. Slump cycles open the opportunities for investors who are a little more savvy to come in and make great deals, because there's got to be, and there's going to be, continue to be some really great deals on the market. And some are already being able to take advantage of that. I know that you writing your lowballing offers, as are many, and they're getting some really great opportunities. So this, when we kind of recap a little bit of all this, let's go back to one fundamental. Real estate as an investment is still an opportunity for you to invest in a hard asset, a store of value. Real estate still works. The opportunities are there. The strategy's got to change. That's it. And for many people, private REITs are going to be a great opportunity to put your money to work because they're more diversified. You don't have to have as much money in. You don't have to go to the bank to get the money, et cetera, et cetera. So that's what I want to say about that. I want to make sure that people are very clear. I'm not down on real estate in any way, shape, or form. I still think there's great opportunities, but you got to change your strategy.
100% agree with you, Patrick. 100% agree with you. So listen, we've talked about the housing shortage and the fact that from many perspectives, it appears to be way over. We talked about inflation down. We talked about interest rates. We talked about housing starts. We talked about Ottawa and their possible CMHC problems. Now, what is the canary in the gold mine?
Well, the canary in the gold mine, is if anybody, and very few people do in the retail sector, by the way, and I'm one of those oddballs that have always looked at precious metals, gold and silver. They are an economic indicator. So what ultimately happens, arguably, and not even arguably, if you listen to the pundits and even the banks, central banks, gold is the only real money. Silver falls into that category, but it has lots of industrial uses, as does gold, but not to the extent that silver does. But they're both considered money. Exchanges they're exchange of value for money. The point is, I can take gold or silver anywhere in the world. I can hand it over to a bank and they will give me whatever currency that if I'm in Timbuktu and they're using Timbuktus, they'll give me that in cash. My point is this: gold and silver gold is hitting record highs. Silver is hitting almost, or I think, a 15-year high, and it's forecast to go far higher. What does that mean? It means that money is going into that particular store of value. Gold is looked at as safe. It is, there's no up, it's safe money. You can exchange it. Point is that liquidity is going into that market. That's because people are really afraid. Investors are really afraid. And institutional money, not retail, has not caught on yet for the most part. Institutional money, central banks around the world have been buying up gold, to a lesser degree, silver, which means the proverbial shit is hitting the fan. We just don't hear it unless you do your research. And if you're researching it, you know that Ukraine and Russia, NATO, the US, China, hanging out with Russia, North Korea, they're in a meeting literally right now. It's east against west, and this is evolving. This is ramping up. But the point is that it affects us from an economic scenario where our costs are going to continue to go up, which includes real estate, because those are stores of value. Those are assets that will continue to rise, because I think also, maybe not by the end of the year, probably mid-2026, and I'll go on record as saying it, I think you're going to see quantitative easing be a necessary part. They're going to put money into the market, and you know what happens.
How does quantitative easing, and I put a chart of gold prices in the last 10 years, Patrick, on the screen just so everyone can see what you're talking about. But what does quantitative easing do for price of gold, real estate, and other assets from your perspective? What is the likely scenario that's going to happen?
Well, we just have to look at 2020. They kicked in quantitative easing, and what happened? You flood the market with capital, and what happens? All assets rise because the dollar is devalued. We are decoupled. I think I shared this. I don't know if I've done enough live events now where I'm presenting. I'm not sure what I've talked about here versus maybe even what I point out at a live event when I'm speaking. But the point is that you consider that the money is flooding in, decouple of the dollar. We then see asset prices go up because the dollar's getting weaker. 1930, the dollar was worth $1. 2025, the dollar's buying power is a nickel, like literally a nickel relative to what was happening in 1930, as an example. That seems like a long time, but we see that. But have your wages increased to keep up? And the answer is no. The average person's wages have not kept up. So the cost of living is going down. And I'll expand on it one other step, JG, that just to say out loud, because we talk about affordability and housing affordability, and everybody's thinking, well, housing is going to be more affordable. Yeah, well, rents are coming down, so that's that part of it. But when you look at the amount of people that can now qualify to buy a home, because the cost of housing, although it's come off its peaks, still not uber low, number one. And secondly, when you look at the cost of living, the lack of increase in salaries, even though prices are coming down, people don't have the discretionary or disposable income to afford mortgage payments that are even at just 4.25 or 4% or 3.99 or whatever that kind of range that they're getting. So we're not seeing affordability really improve. And that's also part of what the issue is in terms of our declining valuation of our dollar. That all ties back, by the way, to gold and silver, quantitative easing. If it kicks in, and I believe it will, it's going to have to. And we're going to see, over the next couple of years, it's going to get messy again.
Interesting, Patrick. I love it. Now let's talk about some YouTube comments, because I am super impressed with some of the YouTube comments we've been getting from people. Like, these are, I always talk about Patrick predictions. These are like the people are making their own predictions, and people have a narrative, and I love it. Whether right or wrong, from their perspective, they're backing it up. So I want to talk about a few of these and go from there. So John, even at 0% interest, how will one pay off these prices? How long, even at an impossible interest rate of 0%, would it take to pay off a mortgage now? That's an interesting question, Patrick, but you're right. 0% interest rate is unrealistic.
Well, but a question like that, by the way, and this isn't a criticism at all, but a question like that speaks to the how uneducated the general public is. Because where do they seek information if they're listening to a channel like ours? And there's other channels like, I want to give a shout out to guys like the Looney Hour and Steve Soretsky as a couple of examples. John Flynn. I mean, there's a number of guys that are out there that are quite good at analyzing the market. The only thing that we bump up against, you and I, JG, as well, is that what do people do with all this information? Because I'm not trying to be doom and gloom. I'm trying to say this is the data, and you need to invest your capital given what's going on economically and what's coming economically. So real estate's that, but you got to change your strategy. That's ultimately it. It's not like curl up in the fetal position in your basement and wait for real estate to change. So there's a lack of fundamental education. You can see that even in John's question.
Well, and I think, Patrick, we've always said real estate for us, as well as for people listening, like, this is a business. This is a place where we choose to put our additional capital to work. So it generates more capital, and it generates a yield on that capital, and it generates a return of capital and a return on that investment. But this is a business. So I love how Pranane, I guess the bottom one here, they're talking about we will see 10 years, their perspective, it looks like his perspective is we will see 10 years of no growth in real estate for sure. Prices were very optimistic, and now the low immigrants numbers and bad economy will burst that optimism. There's another one, Patrick, that talks about, I just want to, because they're kind of related, they're very similar comments. Rachel says, there's like 5% upside and 40% downside in all markets. Unless you're buying for the purpose of your own residence, it's crazy to buy right now, an investment for a long, long time. The stock market is a better way to make money, or better yet, precious metals. So she's in your precious metals camp, Patrick. But it's an interesting perspective how people still see a massive drop in the real estate prices. And I don't see it. I'm happy to explain my position on it. Patrick, what are your thoughts on these two comments here?
The same stuff, right? I think, number one, I disagree with the stock market in terms of that equity market, but this goes back to the stock market can't crash. Well, it will. It'll jump down and it'll jump back up again because they can't. That's just economics. The feds can't afford for that to happen. They are definitely going to feed the system. So feed the beast. The equity market could fall. It'll fall for a short period of time. It'll wipe a bunch of people out. Yeah. But if you can hang on, you're going to do just fine. That's my opinion of that particular asset class. But back to what you're talking about in terms of real estate, where I disagree is, you have to just change the strategy. You need to get your money to work. I agree that this market could, on a lot of markets, and depending on property type, could chop sideways for 10 years. But if you're playing your cards right, you're going to rent it out, you're going to have mortgage buy down, and then you're going to see some significant increases because this too shall pass. It's just part of the cycle. And as long as you're buying strategically, and I'm going to encourage anybody who doesn't have the capital, doesn't want to go to the bank, look at credible private REITs. There's lots of them out there. And within the REIT community, we've got a couple of really really great trusted partners who have got very proven track records and have got great REITs set up. So I don't know if that answers the question or the place to the comment, but I don't think you get out of the real estate market. I don't think that at all. I think you got to shift your strategy.
Well, Patrick, first of all, I just want to acknowledge everyone for these awesome comments. Please keep them coming. This is awesome. We'd love to debate them. Maybe we should have some of these people on the show, Patrick. It'd be a ton of fun.
Let's invite them on the show. Time for some guests.
Keep the comments coming. We absolutely love it. I'll tell you, you just said something interesting there, Patrick, and I think that's there's a part of this that I think the average person doesn't quite understand, that how the system is built. You just said the Fed will keep feeding the beast, and you talked about it as a system. And I think it's interesting, and people need to understand like how the economic system is built and how the collateral system is built, and specifically from my perspective, how real estate and property in general is literally the collateral layer for the entire financial system. They're not going to let it fall very easily because it is the collateral layer. It is the safety zone. So it's very interesting. So this is, to me, why there is definitely not another 40% downside in the market. And Rachel, in your particular case, just to speak to your comment specifically, the stock market's a better way to make money. Well, I would say if you're investing in the stock market, the odds are you're investing in quality businesses that are generating positive cash flow, and you're looking into the future of that, and you're predicting and evaluating how much cash flow it's going to predict. You're discounting it, and then you're purchasing that stock based on that discounted cash flow value. That's how most good investors do it. That's exactly what we do in real estate. It's the exact same thing. And we don't rely on the market appreciating at crazy values that are unsustainable. We rely on predictable cash flow from rents. And that's exactly how we buy real estate. So in fact, you're doing the exact same thing. You're just doing it in a different business. We're doing it in the business of real estate. So just keep that in mind.
100%. And so at the end of the day, we have to pay attention to what's going on economically through a different lens. JG, the world has changed over the past 5 years. Let's face it. It is a different game we're playing. The learning curve has been huge in terms of understanding monetary policy, politics, the relationship between Canada, the US, and other countries. I think for the most part, many people have taken it on, like myself. Like I'm immersed in it all of the time. And the learning and understanding it takes a lot of brain power to figure this out. I'm not that smart. So when you look at what's going on in the world, we have to keep working through to make decisions. And it's not to shut things down, but it is really to put strategies in place to look at what you're going to do going forward to stay ahead of what's unfolding right before our very eyes. So I'm just suggesting that people need to spend time educating themselves and don't think that we can do what we were doing 7 years ago or even 6 years ago or even 3 years ago. This world is changing rapidly, and that is having an impact on real estate and banking and liquidity and what's going on in the US. And we have to look at the East against West and NATO and the Middle East. I mean, there's so many moving parts. It's hard to find good news. I get it. Like, it really is hard to find something positive in all that. And you can find sound bites, and they're really good. We should work on sharing some one day. We just got to find them.
There's lots of good news out there, Patrick. There's no doubt about it. But yeah, and you know what? That is why we in fact do this show, Patrick. Is exactly what you're saying. If people are relying on traditional news channels in order to get their real estate news, you're off to a bad start, and the odds are you're probably going to fail because you don't have the real information. So that's why we're doing this show, and hopefully it's valuable. But I love the comments, so I appreciate that, and thank you so much, everyone. We're going to keep doing this comment section because I love it.
Yeah, it's fun. It's great. The channel's finally. So thank you for liking. Thank you for subscribing. Thank you for commenting, because that gets the algorithms going. And it's only been forever, and we're finally starting to pick up some steam. JG, let's keep it up.
Ladies and gentlemen, that brings episode 72 to a completion. It's been fire. Patrick, thanks for a great show.
Thanks, JG. If you enjoyed this episode and you want to hear more of what JG and I have got, check out our last episode. It was epic.